Hi, I'm Michelle Maynard, Tax and Accounting Partner here at Carbon Group. It is coming up to June, which means it's coming up to tax time, and so we need to let you know what the ATO is focused on this year. And they've come out with a few areas. So the first one, for all of our investors, if you have a rental property, the ATO has declared that they are going to be looking very closely at your tax returns this year. And they are looking at quite a few things. The first one is interest. They want to make sure that you are only claiming the interest on the portion of the loan that relates to the purchase of your rental property. So if you've borrowed a little bit extra to use for renovations on your main house or a holiday, you cannot claim that interest. The second thing that they're looking at is whether you are putting any personal deductions in your rental property tax return. And that could be things like repairs and maintenance around the house, expenditure at Bunnings, those sorts of things. So make sure you're keeping receipts and only claiming in your tax return what relates to your rental property. And lastly, if you have a short-term rental property, they're making sure that you aren't claiming if you've used that property personally or if you have rented it out at a cheaper rate to family and friends. So the main things here, make sure you've got records, you're only claiming deductions that relate to your rental property, and that you are doing the right thing. Has anybody dabbled in cryptocurrency this year? Well, the ATO most probably knows about it. In fact, when we go to do your tax return, we get a warning to say this person has possibly bought or sold crypto. So what does that mean for your tax return? Crypto, you need to think of it sort of like shares. The ATO thinks of it that way. So if you have sold any, whether that be for a gain or a loss, you need to declare that income in your tax return. Swapping one cryptocurrency to another still counts as a sale in the ATO's eyes. So you need to make sure that you keep all those records, but more importantly, you declare any of those gains or losses in your tax return at the end of the year. Making sure you have good records is key here, and there are some great software that help you calculate that gain or loss. But the key thing is make sure you are including it when you do your tax return for the 2023 financial year, because the ATO knows about it and they will be looking for it in your return. Individuals, it's nearly time to do your tax return, and the ATO has said that they are going to be looking at your work-related deductions this year. So what does that mean? First of all, you cannot copy and paste generic deductions from last year. That's a big one that they're going to be looking at. Secondly, you need to make sure that you haven't been reimbursed by your employer and you have records for every deduction that you are claiming. Lastly, they are changing how you can claim working from home deductions. Now, you used to be able to do a cents per rate method at 52 cents, plus add a portion of your internet and your mobile phone. From the 1st of March, they have changed that. Now you need to keep a record of every single hour that you work, and you get to claim a higher 67 cent per hour method. However, that is an all-encompassing rate, so you don't get to claim a portion of your internet or mobile phone on top of that rate. That rate covers everything. There is, however, an actual method, which means you can claim a portion of your internet, home phone, mobile, electricity, all those things that you use at home when you're working from home. However, they are really strict on how you work that out. You need to keep copies of the records. You need to keep records of how many hours you've worked and how often you've used those devices. And it is quite cumbersome, so you need to make sure that you get it right. You need to keep a diary for all hours worked from home, regardless of which method you use. So make sure that you've put that together when it comes to doing your tax return. The ATO thinks they lose about $7 billion a year from people overclaiming their working from home deductions. So it's something that they're really focused on. So make sure you've got your records, make sure you haven't been reimbursed for it, and make sure you've actually incurred the expenses. The ATO has come out with their hit list and what things they're going to be asking for this year. And the big one is records. Records, records, and more records. Anything that you claim in your tax return, you have to keep a record for up to 5 years post the lodgement of that return. And the ATO has the right to go back and ask for those records at any time. If you don't have them, they can actually disallow your deduction, which means you'll have to pay the tax back. So what they want you to do is make sure that you've got records. It doesn't have to be a paper copy. You can scan it. You can have it in a Google Drive. You can have it in anywhere in your technology, as long as you have a copy showing where you've spent your money, what you spent it on, and when you spent it. Credit cards, statements, and bank statements don't suffice. You need the actual original invoices. So make sure whatever it is that you're claiming in your tax return, you have receipts to prove it. If you're using a cents per kilometre method or a cents per hour method, you need to have proof of that as well, being a diary or a logbook. So if you have any problems keeping your records, make sure you speak to someone at Carbon and we'll be able to show you the best way to do it to make sure that you can maximise your claims and don't fall foul of the ATO.